All right, let's talk about a mistake I made, a $10,000 mistake. And it all came from following the single most common piece of advice out there. So in this explainer, we're going to dig into what went wrong, and more importantly, how you can avoid it and build a much smarter portfolio right from the get-go.
Think about it. What's the first piece of investing advice you ever got? I would bet good money it was some version of this, right? Just buy the S&P 500. You hear it everywhere. From experts, from famous investors, it's sold as the smartest, safest, can't-go-wrong move you can make.
But what if following that perfect advice is actually a huge mistake? A mistake that could literally cost you thousands of dollars in gains you should have had? Well, I'm here to tell you, that's exactly what happened to me.
Okay, so let's rewind about 5 years. Picture this. I've got 10 grand ready to invest, and honestly, I was terrified of messing it up. So I did what literally everyone tells you to do. I bought an S&P 500 index fund, and I walked away feeling like I'd made the smartest, most responsible decision of my life.
And look, why wouldn't I feel that way? The case for it is so strong, right? You've got experts like Warren Buffett singing its praises. You're instantly diversified across 500 of the biggest companies in America. It feels less like you're gambling on stocks and more like you're just making a solid bet on the US economy. And with its track record of solid returns, it just seemed like the no-brainer way to get started. So that's what I did. I bought in, set it on autopilot, and kind of forgot about it. And for a while, I felt like a genius watching my balance go up. But then came the wake-up call. It was during a totally routine check-in on my portfolio. On its own, the number looked great. But then, almost on a whim, I did something. I decided to compare how it did against gold.
Now, let's be super clear here. The S&P 500 did its job. It performed really well. Over those 5 years, my investment was up almost 105%. I mean, that's a fantastic return by anyone's standards. So why did my stomach just drop when I saw that?
Because that same $10,000, if I put it into gold over that exact same time frame, would have been up nearly 138%. That's not a small difference. That is a huge difference.
And when you see it like this, side by side, you can really feel the cost of that mistake. Again, it's not that the S&P 500 was a bad investment, not at all. The mistake was believing it was the only good one. And that belief made me completely blind to the bigger story that was playing out in the economy. So yeah, that painful little discovery sent me down a serious rabbit hole. And what I realized was my mistake wasn't just about picking the wrong thing. It was way deeper. It was rooted in 3 critical misunderstandings I had about how investing actually works. Let's break those down.
Okay, mistake number 1. I totally fell for what you could call lazy consensus. Basically, the crowd was shouting S&P 500, so I just nodded and went along with it. I made this huge assumption that it was the best investment for all times, no matter what was happening in the economy. But here's the truth. No single asset is the king forever. Different economic seasons call for different tools.
And look at the data. If you go back over the last 53 years, yeah, the S&P 500 had a better year 31 times. That's a solid record, for sure. But that also means that gold actually came out on top the other 23 years. That's over 40% of the time. My mistake was just assuming I was living in a normal S&P 500 year when the economic weather had already shifted. All right, my second huge mistake was confusing safe with familiar, Because everyone talks about the S&P 500 all the time, it just felt less risky. But risk isn't a feeling, it's a number. It's about what actually happens to your money when things get ugly. And to really get a handle on risk, we have to look past the day-to-day ups and downs and talk about a term called maximum drawdown. Just think of it as the absolute worst-case drop. It's that gut punch fall from an investment's highest high to its next lowest low. That number tells you the most you possibly could have lost if your timing was terrible, if you bought at the very peak and had to sell at the very bottom.
And here's what that looked like in the real world. During that 5-year stretch, the S&P 500 had a pretty painful 25% maximum drawdown. Gold, meanwhile, its biggest drop was only 18%. So think about that. If some emergency had forced me to sell at the worst possible time, my quote-unquote safe S&P 500 investment would have been a disaster. I was so focused on the upside, I totally ignored what the downside could look like.
And that brings me to the third mistake, which was a big one. I was ignoring some really obvious economic warning signs. The clues that things were changing were all there. I just had no idea how to read them. It was clear that smart money was starting to move towards more defensive assets.
So one of the best indicators out there is something called the S&P 500 to gold ratio. It sounds complicated, but it's actually super simple. It just tells you how many ounces of gold you'd need to buy one share of the S&P 500 index. When that ratio is high, it means stocks are pricey compared to gold. When it's low, that's a signal that investors are starting to get nervous and prefer safety.
And this split was so obvious in a year like 2025. Gold absolutely surged, up 64.3%. The S&P 500, it delivered a respectable 16.39%. Now, my account was still going up, which felt good, but I was completely missing this massive shift that was happening under the surface of the market.
So, after all that, what's the solution? Okay, let me be crystal clear. It is absolutely not to sell all your stocks and pour everything into gold. That would be making the exact same mistake, just in reverse, going all in on one single thing. No, the real answer is to build a smarter, more resilient portfolio.
It really comes down to three things that I do now that I desperately wish I'd been doing 5 years ago. Number one, diversify across different types of assets, not just different stocks. Number two, learn how to read the economic barometer. And number three, start thinking about your investments in terms of the job they're supposed to be doing.
So that first step, diversifying asset classes, is all about owning things that zig when your other investments zag. Check this out. In the 9 years the S&P 500 actually lost money, gold went up in 8 of those years. That's why a lot of savvy investors call an asset like gold portfolio insurance. Think about it. You don't expect your car insurance to make you money every year, but man, are you glad you have it when you get in a wreck? A small slice, say 5 to 10%, can be a critical stabilizer for your whole portfolio.
Okay, number two, read the barometer. And you don't need some fancy finance degree for this. All you have to do is occasionally check that S&P 500 to gold ratio. You can find it all over the place online. And if you see that ratio starting to fall, meaning gold is getting stronger relative to stocks, it's not a signal to panic and sell everything. Just think of it like a yellow light on your dashboard. It's just a simple, powerful reminder to ask, hey, are my defenses up? Am I ready for a storm?
And this all leads to the single most important mindset shift you can make. You have to stop asking which investment will make me the most money, and instead start asking, what is this asset's job in my portfolio? The S&P 500's job is to be the growth engine. It's the offense. An asset like gold, its job is to be the shock absorber. It's the defense. My mistake was trying to make my quarterback also play linebacker. You need different players for different roles.
So in the end, yeah, that $10,000 mistake was painful, but it taught me a lesson that's truly priceless. The S&P 500 is a great tool, but it's not a magic wand. Real, lasting financial security doesn't come from finding that one single, perfect investment. It comes from building a smart, robust system, a portfolio where all the different pieces work together to get you through the inevitable storms. It's all about changing your focus from just chasing the highest returns to intelligently managing risk. So I'll leave you with this question, and I really want you to think about it. Look at your own portfolio. What is the specific job of every single thing you own? Is your portfolio all engine, or have you built in some shock absorbers too?